Okay, hi everyone. So last video we went through all the terms that we were talking about with retirement and the different types of retirement plans. So let's take a look at some problems involving these plans. So we have Lilith here, who is 40 years old and she's planning to retire in 25 years. She opened an IRA with an annual percentage rate of 1.25% compounded monthly. If she makes monthly deposits of $500 into the account, how much will she have in the account when she's ready to retire? All right, so we're actually looking at the balance of future value of a periodic deposit. We did this formula a while ago. If you remember when we talked about banking. So we have our balance is equal to our periodic deposit times 1 plus our rate divided by the number of times compounded to the number of times compounded times time minus 1, whole thing divided by rate divided by the number of times compounded. All right, so let's put our values into our formula here and see if we can figure out how much she's going to have in 25 years. So our balance is going to equal $500 times 1 plus 0.0125 divided by 12, whole thing taken to the 12 times 25th power minus 1. Oh, I got to put in a parenthesis here. All right, and then that whole thing is divided by 0.0125 divided by 12. All right, mathematically, I'm going to do the numerator and then divide. So I'm going to do this in parts. 125 divided by 12. Take it to the power times 25. Okay, and then a minus 1 and times 500. Okay, so I'm going to get, that's not right. I got a really bad answer, so let's try that again. 1 plus 0.0125 divided by 12 to the 12 times 25th power. Okay, then minus 1. And then we're going to times that by 500. Okay, so 183 point, let's say 31. And then we're going to divide that by 0.0125 divided by 12. Okay, so I got $175,975.51. Okay, so that's how much she will have in 25 years. Okay, all right, so let's take a look at our next problem. We're still dealing with Lilith here and her annual contribution. So her contribution, that $500 that she made, was pre-taxed. Okay, so we want to know, was it better pre-taxed or not? Okay, so how much should she save in her first year of taxable income if her income pre-tax? Okay, so after she did $500, they took that out before they looked at taxes, and she was left with $72,500 for her income. All right, so let's find out how much tax was on the $72,500. Okay, and so let's find her tax. Now she's single, so we're going to look in the, not single, I'm sorry. Yes, she is single, I'm sorry. She is single, so $72,500. Okay, which would be this row. And this is this year's taxable, so single would be $11,803. Now, we want to figure out, did she save any money by doing this pre-tax? So we got to take her contribution, times that by 12 to figure out how much she put in for the year. So that's $6,000. Add that on to her $72,500 to figure out what her salary was. So that's $78,500. And let's take a look at her tax there. Okay, $78,500 would be this row. And she's single, so $13,123. Okay, so let's find the difference between the two. Okay, so 13,123 minus 11,803. And so she saved $1,320 in taxes by doing its pre-tax. Okay, and again, those tax tables are found in your folders. All right, so now we have Chelsea here, who's 45, and she plans to open an IRA. She wants to have $300,000 in her account when she retires at age 72. How much must she deposit each month into the account with an APR of 1.1% to reach her goal? All right, so this is, again, a formula that we used in the past. So this is a present value of a periodic deposit investment. So this was this formula, where P was your periodic investment. So how much does she have to deposit? Where B is your ending balance. So that's going to be our $300,000. Her rate, 1.1. We're going to go 12 months. Okay, she's depositing every month. So we'll go annually for compounding, or 12 monthly for compounding, over 1 plus R over N to the NT minus 1. All right, so let's put all of our information in. So 300,000 times 0.011 divided by 12, all over 1 plus 0.011 divided by 12, 12 times. All right, now we have a problem. So we don't know how long she's leaving it in there. Well, let's see. Oh, she wants to retire at 62. So 62 minus 45. I believe that's 17. It is. Okay, so we're going to be in there for 17 years, minus 1. Okay, so let's do some math here. So let's do our numerator. Okay, so 275. Okay, do our denominator. And then minus 1. So I get this decimal. Okay, so we're going to take 275 divided by that. And I got $1,338.04. Okay, so we can say she has to deposit, let's round to the nearest dollar. So $1,338 every month for her to be at $300,000 when she retires. All right, let's try this one. We have Xander here, who is a 50-year-old married man who files taxes separately from his wife. Okay, so that's me right there. He's been making monthly contributions to a traditional IRA for many years. Last year, he entered a new business partnership and decided to withdraw $50,000 from his IRA to make the initial investment partnership. Xander's taxable income for the year, excluding the $50,000 that he took from his IRA, was $96,000. How much extra did he pay in both penalty and taxes because of this withdrawal? All right, so the first thing we're going to need to figure out is how much did he pay in taxes to begin with the $96,000. Okay, so let's do $96,000. Okay, let's find his taxes, which happens to be right in the beginning. So $17,221. Okay, now that $50,000 that he took out is considered taxable income, so we're going to have to add that to the $96,000. So with the $50,000, okay, that's going to give us $146,000. Now, if you remember in your tax tables, this is not a list. It goes up to $99,000. which means that we have to jump to the sections where it's over 100,000. So I had to pull up the one that said married but filing separately, which was section C. Now his was 146,000. So if you look, that's the first row. So 146,000. I'm going to times that by 0.24, 24%. So that's $35,040. Okay, and then according to this, it says subtract $5,820.50. Okay, so that's $29,214.50. Okay, so that's his taxable income, all right, that he has to pay. Now, that's just the difference in taxes. We also have to look at the penalty that he's going to have. So let's find the difference in taxes first. So let's find the difference in taxes. Okay, so $29,214.50 minus, that was the tax for the 146, the 17,221. Okay, I got $11,993.50. So there's the difference in taxes. Now, penalty. Okay, I probably spelled that wrong. No T there. Okay, so penalty, we have to figure out how much penalty he had to make. Now, since he withdrew before age 59 and a half, he has to pay 10% of the withdrawal amount. So he withdrew 50,000. We're going to have to times that by 10%. So we get $5,000. So we have to add that to the 11,993. Okay, so that's $16,993.50. And this is how much he paid in taxes and penalties. Okay, for withdrawing that $50,000. All right, let's take a look at this last problem. And this last problem is talking about matching contributions to a 401k that's sponsored by an employer. So we have Leo here. He makes $75,000. His company offers a 401k retirement plan in which they match 50% of his contributions up to 6% of his salary. That sounds confusing. Let's read some more. The company allows the employees to make contributions to a 401k to a maximum of 15% of their salary on an IRS contribution rules that pertain to their particular organization. Because Leo is younger than 50, his maximum allowable contribution is $18,000. How much should Leo contribute per month in order to maximize his employer match contributions? Well, there's two things that are going on here. All right. He can just put the amount into his contribution, or he can do the 50% and 6% thing. All right, so let's look at this where he's going to see, is he already at here $18,000? So we're going to take that $75,000, times it by the 15%. Okay, right here, up to about 50%. So let's find out how much 15% of his maximum salary is. Okay, so that's $11,250. Okay, so he's nowhere near the max of $18,000. So let's divide that by so we can figure out his monthly contribution. So 11,250 divided by 12. Okay, we're going to get $937.50. Okay, so that's him straight putting money into his 401k. Now, maybe he wants to opt into the 6% of his salary so the company matches. Maybe he can't do $937 a month. All right, so let's see what we can do there. So according to this, he can contribute 6% of his salary. So let's find that. So 75,000 times 0.06. So that's 4,500. Okay, and then we're going to divide that by 12 for his monthly contributions. Okay, so we're going to get $375. Okay, so that's how much he's going to contribute. Now, the company is going to match 50% of his contributions up to 6% of his salary. So 50% of the 6% of his salary, basically we're just going to take his salary and times it by 50% of 0.06. So we're going to do 75,000 times 0.03. And we're going to get $22,250. And again, we're going to find out what the monthly company, okay, again, this is what the company is going to match. So 250 divided by 12. So the monthly for the company is $187.50. Okay, so that's what the company is going to contribute to his 401k. So together between him plus the company, is going in $562.50. Okay, so it's smaller than him straight contributing to the 401k, but the company match is not too bad. All right, if you have any questions, please let us know. Have a great day. Remember, staying in means that we're going to keep everybody safe.